Good morning, and thank you so much for joining us for another earnings call for Dolla Financial Services Limited. I am Renee McDonald, the IR lead and CEO of Learn Grow Invest Limited, your moderator for this call. With me today is the Dolla team. We have with us Group CFO Trevine McKenzie, Group CEO, Kenroy Kerr, and CEO of Ultra, David Henriquez. And you will get to see and hear from each of them as we proceed. So please do join me in welcoming Kenroy to the platform once more to host this call. Welcome, Kenroy.
Hi, Renee. Good morning to your viewers, and thanks to everyone for joining us this morning for our Q2 earnings call.
You are welcome, and it's always a pleasure to have you. Do join me in a quick word of prayer, and then I'll hand right over to you.
Sure.
So, Heavenly Father, we give you thanks for this morning. We give you thanks, Lord, for this team that continues to work fervently for the company and for their shareholders and all stakeholders involved. Lord, we give you thanks for them. We pray your blessing over them, and we pray your blessing over this call, that there will be no technical issues, no challenges this morning, Lord. We put it in your hands, and we ask that it will be for all for your glory. In Jesus' name I pray. Amen. All
Amen.
right. So over to you, Kenroy.
All right. Thank you. Thank you so much again, Renee. And again, good morning to our shareholders, those who chose to join us this morning for Q2 earnings call, Q2 of 2025. I'm Kenroy Kerr, CEO for Dolla Financial Services. And as usual, I'm very pleased to be here today to provide an update on the company, some of what would have been driving those financial performance that we made public yesterday, and just the strategic progress that we've made and our plans for the future. And as is customary nowadays, we are joined on this call by Trevine McKenzie. She will provide some insight into the numbers that we published yesterday for Q2, as well as David Henriquez, the CEO of Ultra, who will give us some insight into that segment of the business. No, okay, awesome. So for Q2, I'm just going to go through some quick highlights, and then again, just some of the intricate details of the loan portfolio, what the quality looks like, and some explanation as to what would be behind those numbers. So we ended Q2 with a strong loan growth portfolio strong growth in our loan portfolio. The loan portfolio would have increased by about 49% year over year to $4.5 billion. And of course, all of this growth would have been driven, it's organically driven growth, and a lot of the fruits that we're seeing from some of the product enhancement that we've done over the last several months. Our revenue for the first half of the year ended just shy of $1 billion. We're really, really proud of this milestone in terms of revenue growth, which is a record for us for a 6-month period, and it actually represents a 34% increase year over year. So we're seeing solid growth in our top line. Our profit before tax ended at $252 million for the 6 months ended June. While this represents a 17% decline year over year, we would have seen an 8% growth quarter over quarter. And this also means that we have delivered 4 consecutive quarters of growth. Our profit before tax, of course, again, is a decline year over year. And this is mainly due to some higher loan provisions that we've had to do, as well as some loan write-off of bad debt due to these really stemmed from some external fraudulent activities that involves our loan collateral, and this issue would have affected a small portion of our portfolio. Now, while we can't share all the details yet because there are still investigations ongoing, I can assure our shareholders and the general public that we have acted swiftly by conducting a full review of our portfolio, including some detailed root cause analysis, and more importantly, we have strengthened our internal controls. We've updated our credit models to further reduce the risk involved and to just protect our shareholder value. We have tested these controls and we're confident that these are working effectively. And most importantly, we are now actively pursuing the recovery of the written off loans, and every single dollar that we recoup, you can rest assured that this will go directly to the bottom line and straight to our profit. And with these measures in place, we are confident that we will see some return to normalized profitability and renewed growth in the second half of the financial year. Now, if we look at the portfolio, the loan portfolio, as is typical, we give you just a little breakdown of what the portfolio looks like in terms of diversification, the quality when it comes to ECL and NPL. So for the second quarter, or the quarter ended June, would have seen that the business loans still makes up a significant chunk of the loan portfolio. Approximately 93% of our portfolio represents business loans, and more importantly, about 83% of the loans that we have on our portfolio are now are deemed to be adequately secured. I believe we would have seen a slight decrease in that number quarter over quarter, and of course it's due to the aforementioned issues that I raised earlier. So once we would have completed the review of the portfolio, then we would have made the necessary adjustment to ensure that it reflects accurately what the secured portion of our portfolio looks like. In terms of portfolio diversification, this chart here shows just how diversified the portfolio is. We are seeing that a significant amount of loans or a significant amount of the company's exposure continues to be in the trucking, haulage, and transportation industry, as well as the real estate and construction. The real estate industry would have seen quite a bit of decline over the last several quarters, and we're seeing an uptick in the transportation industry. We continue to monitor these sectors and just continue to look at the trends for our portfolio, and then we are guided by those. We're guided by those trends as we continue to build out our loan products and continue to diversify the loan portfolio. Before I move on from this, I just wanted to touch on our NPL and our ECL. So our credit quality, for the most part, it remains stable, while the NPL ratio is ticking up a bit. I believe approximately 13%, which is above our internal threshold, because we communicate to our shareholders quarter after quarter that our NPL, our internal target is somewhere below 10%. Would have seen an uptick, and it's really driven primarily by a few loans that we have in a delinquent state. However, these loans are actually from the real estate sector, and the collateral that we have on hand are property. We are in the process of liquidating these collateral, or a few of these collaterals, which once we are complete with that process, we are confident that we will see again a downward trend in the NPL number. And of course, the ECL would have seen a slight increase, ticking up to 3.5%, which again is due to the activities that I mentioned earlier. During the quarter, we would have continued to build on our commitment to make an impact through CSR activities, and we undertook several initiatives, but I just wanted to highlight that we did quite a few projects on Labor Day, as well as one of the more significant milestones that we hit during Q2 was the signing of world champion triple jumper Shanika Ricketts as our first brand ambassador. We are very proud of that. It's really a landmark partnership that just reflects our shared value of loyalty, that excellence, and that Jamaican pride, and it really symbolizes our commitment to create that impact and celebrate national achievement on the global stage. And in terms of some of the things that we did during Q2, obviously I mentioned before that due to some fraudulent activities, we would have spent a lot of time just revamping our internal controls, ensuring that the credit risk model that we use, that's being improved and tailored to ensure that we reduce or minimize any further risk going forward. We'd have also made adjustment to our loan products, which not just offers additional features and benefits for our customers, which resulted in quite significant uptick in terms of loan sale, but also to protect the company, protect the portfolio, and of course the various industries that we are targeting for loan products. We just tailored our products to ensure that the risk that we take on are in line with our goal of reducing or preventing any further fraudulent activity going forward. At this time, I will hand over to David, who will just take us through the Ultra segment and what that business has been doing.
Thanks, Kenroy. Morning, everyone. Thanks again for having us. So, as you know, and as Kenroy mentioned, so Ultra has continued our rebrand process to private credit. This is something that will be ongoing for some time as we continue to inform the public that this is the space that we are operating in, and that this is how we plan to move ahead to help medium to large size businesses through whatever, troubles or opportunities they have that we can assist in. And we're pretty proud. I mean, if we could list them, it'd be awesome. But, we've seen some great wins for our customers, and we continue to push ahead to be able to help the numbers. Our loan book is now sitting at 1.7 billion. And some may ask if there was not much of an uptick since last quarter. This just shows that we've had a steady disbursement rate, as well as we've been collecting a fair bit as well. And our collections and disbursements have been on par, which is why the number has held steady. And our collateral being held just about 3.6 billion. As you know, our loan to value ratios hover between 30 to 50%. So we continue our numbers will move along the same trajectory and are quite cohesive. So as Kenroy mentioned, we have had a few fraudulent loans that we have provided for. And due to this, our profit before tax did take a bit of a hit, but we are confident in our abilities to recoup from these fraudulent activities. As you know, Ultra's loan book is 100% secured. So we are in the process of trying to recover from these hits, but we are confident that we will be able to do so. And as Kenroy mentioned, all of these figures, every dollar collected will move to our bottom line. So as we move forward for the year, our aim is to get our loan book to over $2 billion, which we are on track for, while maintaining an NPL of under 10%. In previous earnings calls, we had mentioned keeping our NPL below 5%, but as we had expected, due to the nature of our business and the nature of our loans, there would come a point where our NPL would climb, but it is something that we are not worried about. We do keep a close eye on, but we are not worried about because we are secured. So yes, it does take some time to liquidate assets, especially in the real estate segment, when that time comes. So there will be a fluctuation in our NPL, as the business moves forward, but we are confident that we will be able to liquidate these assets and continue to keep our NPL under control. We continue to aim to improve the quality of our collateral. This is very, very important to us because, as you know, when it comes to liquidation, the quality of the asset, it really does come into play. And we continue to try to diversify the collateral being held. So we're not always sitting down trying to sell property, but we will have stocks to sell. We'll have motor vehicles, equipment, etc. So we continue to push to diversify and strengthen our loan book as well, and continue to develop a dynamic team which will push this ahead. Our team still sits at 16 members, which we've all the same team members that we've discussed and mentioned before. And, you know, we continue to push from strength to strength with, you know, our goals in sight, and our goals are reachable. And we do intend to do that to give our shareholders confidence and to continue to help the Jamaican public. We are always focused on improving our processes, both internally, and our focus is always our customer, for them to have the most comfortable and seamless experience with Ultra, so that they want to continue to do business with us, because we can help them and their business move forward. So at this point, I will introduce Trevine McKenzie, who is no stranger to anyone, who will take us through the numbers.
All right, thanks, David, and good morning to everyone on the call. We are so happy that you took the time out to join us this morning, and for our viewers who will be listening a little bit later, welcome as well. Now, for the period ended June 30th, 2025, we experienced growth in some areas, and we recognized areas for improvement in others, but nevertheless, we are happy that we produced a profitable quarter. And as usual, we're proud to report the results to you, our shareholders and our viewers. So as usual, some highlights for you. Our total income stood at $994 million, which increased just about 34% year over year. And this 994 really represents us meeting our internal targets. We really are seeing strong revenue growth from all the lending that has taken place over the past few quarters. And we're really happy about that we were able to meet our internal targets in terms of revenue growth. Our loan portfolio also increased by 49% to $4.5 billion. And this was due to the tremendous work of the sales team. Also, over the past 2 quarters, we're seeing where lending has been consistent, and we're really happy about that. Now, our profit before tax stood at $252 million, which represents a 17% decline year over year. And this was due to the unforeseen increase in expenses that our CEO just mentioned. We saw a 76% increase year over year to $560 million for the period. And, Kenroy did mention what took place there, but I will go through that as well once we look at the P&L. Now, in terms of our key performance indicators, those remained in line with our internal targets as well. For the most part, our ECL stood at 3.5%, remaining flat year over year, which is positive, and it's a good indication of the strength of the loan portfolio, especially given all the activity that has taken place over the past few quarters. NPL also stood at 12.8%, which is also strong and still below industry average. And our efficiency ratio stood at 56%, and this was due to the increase in expenses that I will also take you through in the profit and loss section. Now, in terms of our balance sheet, we saw downward movements in cash, and this was due to our interest payments that we would have made at the end of the quarter. As you know, we have done an additional fundraise in Q4 of 2025, which would have increased the payments that are required to be made every quarter. But we would have done that, reduced our cash a little bit, but we also saw upward movements in loans payable due to the bond raise in Q4 of 2024 and an increase in other payables and accruals due to the general cost of doing business. There is nothing remarkable about that increase as well. Now, we continue to see increases in our loan portfolio due to the consistent lending, as I mentioned, over the period. And just the business taking advantage of the demand for our product offerings on the Dolla side and on the Ultra side. So we'll continue to see increases in the loan book as we have promised to our shareholders. And in terms of the increase in retained earnings and shareholders' equity, that's simply due to the increases on the P&L side, which we will now go through. Now, as I mentioned before, we had a strong income performance. We're looking at almost $1 billion in terms of income for the end of the period, and a strong 34% increase year over year. This would have properly cushioned the expenses of $560 million, taking us down to a profit before tax of $252 million as at the end of the period. Now, as we mentioned before, this represents a 17% decline year over year. But notable here is that we would have seen a decrease year over year in terms of quarter over quarter profits. But if we look at March versus June, we're seeing where we would have moved from $121 million in terms of the quarterly profit reported in March versus $130 million in June. So we would have promised that we would have increased our profits quarter over quarter, which we did. And we're really happy about that, especially despite the fraudulent activities that we would have seen. Now, if we delve a little bit into our operating expenses, we're noticing a 76% increase, which is quite heavy. What we would have experienced in March and June of this year, an uptick in fraudulent activity. So we would have seen a small portion of the portfolio being affected by that. We would have done the proper accounting for that. We would have strengthened our controls. We would have tested them to ensure that they are working. And management is committed to ensuring that these loans are recovered and every dollar will return to the bottom line. So we are seeing this happening. It's happening a lot in the financial sector, but we are doing what we can to ensure that this is contained and that we are limiting the reoccurrence of these issues. And what we would have done also as management was we would have recalibrated our expenses to ensure that we're able to manage the bottom line. So, and you would have noticed this in terms of our quarter over quarter profits. We recognized that, we would have experienced this uptick in expenses because of the fraudulent activities, and we would have looked through our expenses to ensure that we are cutting where we need to, we're balancing where we need to ensure that the bottom line is as unaffected as possible. Now, if we move on to our cash flows, we are seeing where, of course, we're utilizing cash in terms of our operations. Our last fundraise would have been in Q4 of 2024, and we are just utilizing the cash we have to ensure that we're able to pump back into the loan portfolio. So we would have seen that in terms of the movement in cash used in operations and cash used in financing activities. Of course, we would have looked at the loan payable movement. But all in all, we would have ended the period with $47 million in terms of cash. And we are continuing to build cash throughout the Q3 period to ensure that we're able to fulfill our obligations in terms of our interest payments and, of course, increase our lending to ensure that we are maximizing our revenues and we're able to fulfill the demand that we have in terms of the loan space. Now, at this time, I would like to hand it back to our CEO, Ken Walker, to just take us through our plans for the rest of the year. And over to you, Ken Roy.
All right, thanks again, Shervine. So in terms of the second half of 2025, of course, our major focus now that we have implemented new controls would be to have continued growth in terms of our revenue line. We do believe that based on the changes that we've made over the last several months, based on the work that we've done in terms of sale and growing the portfolio, that we will see continued growth in the top line, which is our revenue. That has been stable for the last several quarters and for the first half of the year, and we expect that growth in terms of income to continue. We will continue to just look at the different sectors. As I said before, there are areas that we find that we might be a little bit too exposed, and then other areas where there are opportunities that we can leverage and grow. So we are refining the products, just targeting, continue to target those micro and medium-sized business in the sectors that we deal, that we consider to be growth, to have high growth potential. Continue to refine the credit scoring and the underwriting models that we use, and of course our focus. We have done a little bit of automation in Q2 relating specifically to our collections, and we have seen some improvement in terms of the cash that we collect on a monthly basis since we have done those automations. So we will continue to do whatever we can for the rest of the financial year to see if we can get some further positive result both on the collection side and in terms of increasing overall efficiency for the company. And finally, we are working on a fundraise. We are actually in discussion with our financial advisors about a fundraise for the latter part of this year. As soon as we're able to provide more details on that, we will. But it's something that we are also working on as we seek to continue to grow the portfolio, continue to grow the revenue line, and improve the value that we return in terms of profitability to our shareholders. So in closing, and before I get to your question, I just want to reiterate that the income results for Q2, they are encouraging without the fraudulent activities that we would have mentioned throughout this call. I know that Q2 would have been, or the first half of the financial year, without those activities, we would have seen at least a 25% increase year over year in terms of profit before tax. But I mean, it is, at this point in time, we really just have to do all the work that we can to recover, and as I said, to add back to the bottom line. And then the steps that we're taking in the second half of the year, the steps that we've taken in Q2 and the steps that we will be taking going forward, we are very, very optimistic that for the remainder of the year, we will be seeing some good or healthy level of growth and at least our year-over-year growth when we finish our third quarter. So I just want to thank you for the support and the trust, and obviously I now look forward to any questions or comments that you, our shareholders and stakeholders, may have for us.
Thank you so much for that, Kenroy and team. I'm gonna bring David and Traveen back to the platform so we can get right into the questions. So thank you again for, as always, the transparency and the information that you have provided. The report itself gave some good information, and of course you provided greater context to what it is that we have read. So we have a few questions in the chat, and I'm going to group some of them, or run some of them back to back, because as expected, there are a few questions about the fraudulent activities, etc. But the first question that we have is from Philip, and he first congratulates you on the revenue growth and was again asking for more color on the fraudulent asset pledging and measures being used for recovery and to protect the company in the future. You would have touched on that. I don't know if, based on his question, if there's anything else you'd like to add.
Just to say that I think I mentioned earlier that there are, we can't give too much detail on the nature of those activities at this point in time, but I can assure you, Philip, that the controls that we have put in place, especially when it comes to dealing with the collateral aspect of our business, we have implemented. The truth is that we started implementing some new measures even before these came to our attention, but since then we have even tightened those much more, and I do know that we will not be seeing those kind of activities based on those controls that we have put in place. And not just the security, the fact is that we have done a comprehensive review and we have implemented other measures where we see to fill any gaps that we may see, any level of vulnerability for the business.
All right, thank you for that. Kirk is asking, what % of the loan portfolio was affected by the fraudulent documentation?
This was approximately somewhere about 3%, 3% of the portfolio. Trevina, I'm not sure if you...
Yes, between 3 to 4% of the portfolio was affected. So a small fraction of loans.
All right, thank you. And I think this was the same question, so just acknowledging it, we're gonna move right on. I believe those are the fraud questions that I saw. And then Kirk also says, beyond fraud, what caused the 76% rise in operating expenses? And will this persist in H2? I think it's more about the latter part of the question, because Trevine, you would have addressed in your presentation what actually caused the increase.
Yes, so the vast majority, of course, would have been due to the fraud. We would be required to write off those loans that were impacted. Outside of that, you would have seen in the media that we would have increased our marketing initiatives. We gave away a car, we're running a promotion. So all of those things are expensive, but would have contributed to the top line, as you would have seen. So it's between marketing and the fraud would have been the majority of the increase. Everything else would have remained flat, and we would have been deliberate about that, especially because we would have recognized that the fraud would have really impacted our expenses.
Understood. Philip says, given your expertise in the money industry and synergies with your new large shareholders, how far are we from becoming cashless, employing modern features like digital wallets and crypto-enabled transfers?
All right, so I'll touch on this. So first and foremost, we have removed, our operation is really cashless at the moment. I know that the customers, they pay online through Bill Express. Through Bill Express, they do use cash, but just building on that question, our major shareholder, of course, have been doing some work in terms of this era where it moves us even further away from customers actually making payments via cash, and for easier way for us to credit funds to our customers, especially because a lot of them are unbanked and in some instances would not have the traditional means of receiving funds. So we have been in dialogue with them, and obviously with that partnership, we do hope that in the near future we'll see some continuous growth when it comes to that segment of the business.
So just following up on that, I know you would have had some conversations in previous earnings calls about automations. You mentioned today about automating on the collection side of things. So is there any further update on that piece that you were working on before, or is it the same, or is it one and the same?
Well, one thing I can tell you, Rennie, and thanks for that question, is that automation takes time and takes a lot of money. Very, very expensive. So we have a framework. We have to approach it in stages. And as I said, luckily for us in Q2, we were able to make some improvements where the collections aspect were relating to collections, and we have seen improvement in overall collections for the business. So we are working on the other stages, whether it includes the workflow process that we use, and even just some basic KYC stuff. There are things that we have to implement which are mandatory by the BOJ, our regulator. So we have to prioritize those first before we even get to some of the other things that we need to do, just given the cost that it takes to do so. So we, apart from the collections, we have done some automation when it comes to this KYC screening and just email checks and things like those. So we just have to take it in stages. As I said, it's really a time-consuming project, and it's also a very expensive one. And especially, we kind of have to manage the expense and be very rational in terms of how we approach building out our automated system.
Yeah, and just to put some color to that too, Philip, in terms of the digital wallets and the crypto-enabled transfers, we also have to look at where BOJ is at in terms of crypto. We're a regulated company, so we have to ensure that we're taking into account everything, the framework that they have put in place to accept those kinds of funds as well. And our customers are very simple. So to invest $10-20 million to build out a platform or to build out something that can accept digital wallets and crypto, and we won't see the return on that, that's something that we have to take into account. It's very important that we are looking at the ROI on these investments.
Right, absolutely. And I can attest to what Kenra would have shared as an experienced IT project manager. I do know that it takes time, right? And it does take quite a bit of money as well. And typically the focus first is the regulatory and the compliance related items, or that aspect of the project and the development, the automations. And then you can go more into the customer facing things. So it's good to know that you are taking the agile approach to it and doing things in stages, so that your shareholders, your stakeholders, your customers will see some improvements while you continue to work on all the other aspects, right? So well done on that as well. The next question is from Kirk, who says cash and equivalents fell 98% in the 6 months. Is there a liquidity crunch despite loan portfolio growth?
So remember, in Q4 of 2024, we would have done a large fundraise. We would have raised $1.6 billion. And that's at the end of that December period. Some of that cash would have been left sitting. So comparing it to a point in time when we would have received $1.6 billion versus now when we would have unlent and we're operating organically, it's a little bit different. But at this time, I wouldn't say there's a liquidity crunch. We are collecting and we're lending and we're fulfilling our obligations just fine.
And as you guys always remind us, cash is your inventory, right?
That's correct.
That is important to remember as we proceed. Lavaine asks, does the company have a max percent with regard to the NPL? Ken, are you taking that one?
Sorry, I didn't get that question.
Does the company have a max percentage with regards to the NPL?
So we'd have shared, for the most part, I believe it's public knowledge that our internal target is 10%. The reality is that we are faced sometimes with situations where we have no option but to seek to liquidate the asset that we have on our portfolio for loans that are in a non-performing state. At this point in time, we ideally always want the NPL to be below 10%, but being realistic, there are customers who will face difficulties, and there are customers who we'll work with them. We will do refinance if it's their first loan and they've shown that they have the ability to fulfill. But where we have taken all steps, where we have taken all steps to assist the customer and we are not seeing the results, then the only option is to liquidate the asset. And the main reason for the over 10% NPL at this point in time is because we are in the process of liquidating some properties which are in various stages of sale of the sale process. And we do anticipate that once those sales are fulfilled, we should be in a position that we're comfortable and below the 10%. Of course, this is one of the ratios that a lot of, I don't think you ever open another for microfinance company, you ever open their financial results and see their NPL ratio, but it's one that we have been very transparent with, and we will continue to keep you up to date on this aspect of business.
All right, thank you for that. Terence is asking, are you sufficiently capitalized, or is there another capital raise on the horizon, which you would have addressed? If yes, how will capital be raised and when?
So at this time, we are happy that we're not sufficiently capitalized based on our ratios. Kenroy did mention that we are in the process of organizing a fundraise to be executed by the end of the year. In terms of specific dates, we're not at liberty to say at the moment, but as soon as we have the information, you will definitely see it. It will be a public raise, so just look out.
All right. And on the tail of that, Kirk says, no APO, please.
Okay, Kirk.
Just ensuring that you're hearing what your shareholders are saying, right?
Oh, we hear them. We hear. We listen.
All right. Next question. Please share the company's position on reinvesting versus dividend payments.
So we would have spoken about this on previous earnings calls. Our priority for the business is always to allocate capital in a way that maximizes long-term growth, which includes, taking into account the cash that we have on hand and repurposing that in the best way. And right now, based on where we are, and as you can see from the financial results, it's reinvesting into the business, building our products and lending so we can build cash, we can build our revenues, and then we can return to, increasing our dividend payments to our shareholders. So the aim is to get back to paying dividends, but we have some work to do in terms of reinvesting in the business so we can get there.
Understood. Thank you. And Jerome says, growth has been affected despite significant growth in the loan portfolio in the last 18 months. What are the strategies to increase margin of profitability?
So you want to take that, Ken, or you want me to take it?
I mean, you can go ahead, Shireen, for sure.
Okay. So in terms of, increasing our margin of profitability, as we said, we are really happy about our revenue growth. We're basically at $1 billion half year, which is, record for us. So at this time, it's just managing the expenses, and we are doing everything we can to manage, the fraudulent activity that took place, and just ensuring that all our other expenses outside of that are as minimal as possible to ensure that the bottom line is as unaffected as it can be at this point in time. So it's just about managing expenses to get us to where we need to be.
All right. And the last question I'm seeing right now from the audience is from Jerome as well. What % did Ultra contribute to net profit?
So at this time, Ultra would have contributed just about 30% to net profit based on where we are.
All right. One more question came in. What contingencies do you have to counter a shock in the market like 2019 COVID pandemic? Well, 2020 for us.
So I believe COVID taught us some meaningful lessons, Matt. Obviously, one of the strategies that we've employed since that time is to focus more on business-related loans, and also looking at industries where we've seen great resilience, especially in the time of a pandemic that we've experienced over during 2019, 2020. I believe when a lot of companies during COVID saw some dramatic decline, which we did. I mean, every company saw some decline, but we were still able to be in a profit position just because of the composition of the portfolio. So it's really ensuring that the portfolio is well diversified. The secured loan approach has been a really important approach for us in terms of protecting the portfolio. So even at the end of the day, if we are not able to collect them, we have something that we can use to recoup the funds that we have lent. And again, we have moved also away from some of those industries that we were in, that we saw the greatest impact during a pandemic, and we'll just continue to monitor, ensuring that we're not too overly exposed to those industries. Okay. But a lot of the focus and emphasis has been for us, as you can see, 93% of our portfolio represents loans to businesses and entrepreneurs. And these are people, whether we have a pandemic or not, they will push to make an income. And obviously, that's where we can still get some payments in those unfortunate circumstances.
All right. Well said. Thank you. Jerome says that Ultra's contribution is lower every quarter for the past 3 or so quarters. Why is this?
So in terms of Ultra, the subsidiary company did experience a fraction of the fraudulent activity that would have taken place, and their portfolio represents about 37% of the overall portfolio. So we would have seen where their impact was a little bit greater than on the Dolla side, as well as we do have strong, let's say, consistency in terms of lending on the Dolla side. But in terms of Ultra, as we know, these loans are a bit larger. And we're seeing where it does fluctuate at times in terms of lending on the Ultra side. So those are the two factors that would have contributed to, the movement in terms of contribution.
All right. Thank you for that. 11 Coco says, since dividend payments act as a buffer to stock price stability, can we expect a dividend payment this quarter?
11 Coco, we can't come on and say, oh, we're expecting a dividend payment this quarter. We are a listed company, and if we are considering a dividend payment, if a dividend payment will be made, we always advise we have to under the JSE rules. So you can look out for any announcements regarding dividend payments.
That's right. Jerome is asking, from your point of view, which segment has more growth potential, the microfinance or private?
I think it depends. I believe I'll just make a note, and then David probably can chime in from the microcredit, from the private lending segment. For me, it's really depends on what you aim to achieve. For the microfinance sector, I believe you can. You definitely have more diversification. You have a system where your average loan size is way smaller, and that thus reducing your overall risk or exposure to one customer. So there are benefits on the private credit side. David will speak a little further about these loans tend to. There might be instances where you have to take a little hit on your margin because of the size of the loan and how you negotiate and things like those. So it's kind of relative depending on your cash position, the amount that you need to lend out at a particular time. Both have their own benefits, upside, downside, I would say.
Yeah, I think you hit the nail on the head there, Kenroy. So basically, I think private credit has a definite massive potential for growth, but based on the size of our loans, it also takes a lot of capital to be able to satisfy the needs of our customers. And when we look at the business on a whole, if let's say there's $30 million and we have the potential to lend it to either one customer on the Ultra side or 30 customers on the Dolla side, it will benefit the company on a whole to lend it to the 30 different customers at Dolla. One, because the interest rate is not as closely monitored, and two, you have more diversification when it then comes to receiving payments, collecting in default situations, and you have a lesser chance of somebody defaulting on a $1 million loan than they are defaulting on a 30. And we definitely, as a company, will take a larger hit if we have to then wait 5, 6, 7, 8 months to liquidate on a $30 million loan versus collecting on a $1 million loan. But as I said, private, there's a massive need for funds in the private credit space. So we just need to continue to operate as carefully and prudently as possible and continue to navigate the waters, for lack of a better word, and just continue to do what we're doing and improve our processes and diversify our customer base.
All right, thank you both. And I believe that was our last question. I will say to the audience, if you have any other questions, please go ahead now. We have a few more minutes with the team. Please go ahead and put those in the comment section. If not, after the live video, you can go ahead and post below the video, and those comments will be shared with the team for their response. And I just wanted us to tie up one little loose end. A few calls ago, we would have touched on the winding up of the Guyana operations, and we haven't really closed that out. Can you give an update to your shareholders on that piece, Kenroy?
Certainly. So, in terms of the financial impact on the financial statements, I believe we would have and Trevine mentioned this earlier, that one of the small contribution to an increase in the expenses would have been from the final provisions that we had to make for the wind up of Dolla Guyana. I think we have fully provided and closed out the financials for Q2, and we're just now in the process of completing the legal wind up. So this is something that we should be completed with by the end of the year.
Fantastic. Sounds great. All right. And I do not see any more questions coming in. So thank you so much, Kenroy, Trevine, David, as always, for providing the context, for taking the time to share with your shareholders, to speak to your people, and give the information that is necessary so that investors can make informed decisions. We thank you for your commitment to your earnings calls. We thank you for your timely release and your timely meetings with us. It is greatly appreciated. And we thank our audience as well for being here and participating so actively in the chat. All right. So
thank you. Always a pleasure.
Absolutely. With that, I believe we will go ahead and close out. So thank you, everyone.